Assalamualaikum warahmatullahi wabarakatuh. In this video, I will explain about the rate of return. The explanation in this video covers two things, namely, one, definition of rate of return, two, ERR calculation step, three, ERR calculation based on present world, and four, ERR calculation based on annual world. One, what is the rate of return? Rate of return is interest rate at which the present value or annual value of the net flow of one equals zero. The rate of return is interest rate at which the value equivalent of an alternative technical design is equal to the value equivalence of other technical design alternative. A rate of return can be applied to any investment from real estate to bonds, stock, and fine art. The ROR works with any asset provided. The asset is precise at one point in time and produce cash flow at some point in the future. Investment are assessed based in part on past rate of return, which can be compared against assets of the same type to determine which investment are the most effective. Many investors like to pick a required rate of return before making an investment choice. Problem. There are two problems. One, what if the market interest rate is less or more than the specified interest rate? Two, in the market interest rate that big, market interest rate equal MARR, minimum attractive rate of return. Three, what is the limit on the interest rate of an investment with the expected flow of fund to generate profit. Rate of return can be calculated based on the concept of present worth or annual worth, namely by the equation. Present worth of income is equal to our present worth of outcome. Annual income is equal annual outcome. Then look for E or ERR that satisfy the equation by trial and error. An investment is usually compared with bank interest rate, MARR, or minimum attractive rate of return. Like the present worth, future worth, and annual worth method, the rate of return can be applied to compare or choose alternative. This rate of return can be used as a discussion-making pattern, namely if ROR more than MARR, then a technical design with a higher initial cost. Higher cost alternative is chosen. Conversely, if ROR less than MARR, then a technical design with a lower initial cost. Lower cost alternative is chosen. ERR calculation step. 1. Check whether the flow of fund side. Fund income means outcome net more than zero. If yes, then continue. 2. Create an equation. Present worth revenue means present worth cost equals zero, or AR means A equals zero. 3. Perform trial and error by entering a price, E1 and E2 into the equation to produce present world 1 and present world 2 or any A1 and A2. Interpolate on A1 and A2 for present world equals 0 or A equals 0, resulting in I approximation. 5. Repeat step 3 and 4 for I1 and I2, which approach I in the step 4. 6. Plus interpolation is done if E2 mean EI is equal 1% and produce two price with opposite sign, positive and negative of the equation. This last interpretation is the result of ERR calculation. Case study. Then this slide shows an example of implementation and calculation of the ROR. A business intends to increase investment to buy equipment for the smooth running of the business. The equipment costs 200 rupiah and has an annual exploitable cost, operation and maintenance cost of 50 rupiah for 1 year. With an economic life of 10 years, the resale value of the equipment after its economic life is estimated at 60 rupiah, while the income earned by equipment is 100 rupiah and is known that the bank interest rate MARR is 20%. On this issue, we will find out whether the process of the equipment is worth investing in or not by using the ROR method. This is my explanation. I hope you can understand it well. Wassalamualaikum warahmatullahi wabarakatuh.